welcome to the research desk. You know, the most expensive illusion in modern quantitative finance is, it's the illusion of symmetry.
Absolutely. The whole industry is practically built on it.
Right? Every single trading day, you have analysts and algorithms monitoring global markets, just watching millions of time series dance in this apparent synchronization. They calculate correlation coefficients, observing that, asset A and asset B are moving in perfect lockstep. And they generate these beautiful symmetric heat maps.
Yeah, they love a good heat map.
Exactly. But knowing that two markets correlate is mathematically interesting, sure, but financially, it's worthless. The actual edge that generates billions of dollars in alpha lies entirely in asymmetry.
Knowing who's leading and who's following.
Exactly. Knowing exactly who is leading and who is following. And while I am advocating for the position that transfer entropy is the ultimate definitive tool for mapping this architecture, it captures the directional, nonlinear flow of information, and it transforms market analysis from just, observing simultaneous events to charting precise causal chains.
I hear you. And I am taking the opposing view that while transfer entropy is a theoretically elegant concept, it's derived from physics, which is great, deploying it in the noisy, non-stationary environment of global capital markets is a literal minefield.
A minefield? That's a bit strong, don't you think?
Not at all. It suffers from severe data hunger, extreme parameter sensitivity, and while this pervasive illusion of causation, I'd argue it makes it highly susceptible to data mining, which basically masks estimation noise's profound structural insight.
Okay, well, to understand why this shift from symmetry to asymmetry is so vital in the first place, we have to examine the catastrophic failure of the tools the industry currently relies on.
You mean Granger causality?
Yes, Granger. For over 50 years, the economist's absolute workhorse for directional analysis has been Granger causality. It was introduced back in 1969, I believe.
1969, yeah.
Right, and it attempts to solve this exact problem by asking a very straightforward question. Do past values of variable x improve our ability to predict the future values of variable y beyond what the history of y already tells us? It sounds entirely logical.
Well, it is logical, and there is a reason it's survived for over half a century. Granger causality provides a highly constrained, easily computable framework. It prevents the model from finding patterns that simply do not exist.
Sure, it prevents finding patterns by ignoring the complex ones entirely.
But the critique against it, which, I acknowledge is historically accurate in specific contexts, centers on its foundational assumption, which is linearity. Granger relies on linear vector autoregressive models.
Exactly.
It assumes the relationship between two financial variables can just be plotted on a straight line.
Precisely. And in completely calm, highly liquid, normal market conditions, that linear assumption holds up reasonably well. But capital markets do not operate in a perpetual state of calm.
Fair enough.
Think about the exact moments when knowing the directional flow of information is most critical to your survival. I'm talking about panics, crashes, cascading margin calls, sudden macroeconomic regime shifts.
When everything goes haywire.
Right. During those periods of extreme stress, relationships in the market go violently nonlinear. Correlations spike to 1. Everything sells off together. Linear models completely break down because the underlying market dynamics have mutated into exponential or chaotic states.
Look, the failure of linear models during structural breaks is well documented. I'll give you that. But we need to explore exactly how transfer entropy claims to solve this.
Okay. Think of a billiards table.
All right.
If you use Granger causality to observe the game, it watches ball 3 moving toward ball 7, and it attempts to predict ball 7's final resting place using a straight-line linear extrapolation.
Right. It just draws a line.
Exactly. It ignores the complete physics of the collision entirely. Transfer entropy, by contrast, operates completely on probability distributions. It doesn't demand a straight line.
Because it's tracking states of uncertainty.
Exactly. It tracks the actual nonlinear collision dynamics, It measures the transfer of momentum, the angular deflection, the kinetic spin applied from one object to another. By measuring how the state of ball 3 mathematically reduces the uncertainty regarding the future state of ball 7, it captures the full complexity of the interaction, regardless of its functional form.
I mean, the billiards analogy perfectly illustrates the theoretical ambition of the tool. I'll concede that. But we really must interrogate what happens when that physical ambition meets the messy, psychological reality of financial data.
I wouldn't call it messy. I'd call it complex.
Well, when you remove all functional form assumptions, when you just stop demanding a straight line, you throw open the door to extreme overfitting. Let's examine the specific literature that's often championed to prove Granger's obsolescence.
You're thinking of the Yao and Lee study, aren't you?
I am. I'm looking at the study by Yao and Lee, published in Frontiers in Physics in 2020. They track the relationship between social media sentiment on Twitter and cryptocurrency prices.
And that study is the perfect empirical demonstration of the failure of linear tools.
They analyzed the data between 2019 and 2020.
Right.
The headline result is striking. When they ran Granger causality on the relationship between Twitter sentiment and crypto prices, it found absolute zero statistically significant signal.
Zero.
The linear model saw nothing but noise, which, if we're looking from a traditional econometric standpoint, suggests there is no predictive relationship.
But there was a relationship. Transfer entropy measured 0.15 bits of directional causal flow from Twitter to crypto, and that finding was significant at the 1% level.
That's a very specific measurement, yeah.
We have to explore why this massive numerical disparity exists. Why did Granger find zero, while transfer entropy found a highly significant flow of information?
Because of the threshold effect.
Yes, it comes down to the mechanics of human psychology and social media. Sentiment operates on threshold effects. A few isolated tweets do absolutely nothing to move a market.
Right, you need a cascade.
The sentiment must reach a critical mass, a full cascade, before it drives price action.
You're describing a step function.
Exactly. It is flat, 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 and then a sudden, violent spike in price once the psychological threshold is breached. This behavior is completely invisible to linear regression. Granger causality tries to fit a slope to a staircase and it just fails. But transfer entropy measures states of uncertainty.
Because the entropy drops.
Yes, when sentiment builds on social media, the probability distribution of future price states compresses. The entropy drops. The Twitter data is actively resolving uncertainty about the future state of the crypto market.
Okay.
That 0.15 bits of directional flow is exactly the asymmetric edge I am referring to. I mean, for an institutional trading desk, the difference between zero signal and 0.15 bits of directional flow is the difference between abandoning a data project and allocating hundreds of millions of dollars to trade its outputs.
The detection of 0.15 bits of information flow is mathematically accurate within the strict confines of their dataset. I do not dispute the calculation itself.
Good.
However, we must strictly avoid the interpretation trap here. This is exactly where the practical minefield begins.
The interpretation trap?
Yes. The fundamental mathematical definition of transfer entropy is simply that variable x reduces uncertainty about variable y. It does not prove that x causes y in any economic or physical sense whatsoever. We must consider confounding variables.
You are suggesting a third unmeasured factor is driving both the tweets and the price.
Precisely. Let us look at the specific era of that study, 2019 and 2020. The cryptocurrency market during that window was driven heavily by shifts in macro liquidity and central bank policy.
Sure, macro liquidity was a factor.
Right, so suppose there is an unmeasured variable. Let's call it variable Z, representing global fiat liquidity expansion. That liquidity expansion could very well be driving both the speculative fervor on Twitter and the price action in the crypto asset simultaneously.
But
Hold on, let me finish the thought. If the macroeconomic variable Z acts on the Twitter sentiment just slightly faster than it acts on the crypto exchange price, transfer entropy will confidently report that Twitter is driving Bitcoin.
right.
The metric is completely blind to the unmeasured Z. It will literally dress up a coincident reaction to macro liquidity as a profound structural discovery.
Okay, but that is a standard critique of any bivariate analysis, not just transfer entropy. You can condition the transfer entropy calculation on third variables to isolate the direct flow.
You can, yeah, if you know what the third variable is and you actually possess the clean data for it. But my deeper concern with this specific study is the asset class itself.
Crypto.
Yes, crypto. Finding a nonlinear signal in a notoriously speculative, retail-driven, highly inefficient asset class like 2019-era cryptocurrency does not necessarily justify discarding linear models across the board.
I'm not saying discard them entirely.
Well, cryptocurrency is a market practically defined by momentum cascades and retail FOMO. Granger causality computes in fractions of a second and requires vastly less computational overhead. It remains a remarkably robust tool for mapping standard economic transmission mechanisms in mature markets where those threshold effects are just less pronounced.
The interpretation trap and the influence of confounding variables are valid concerns when you're looking at isolated pairings like, Twitter and Bitcoin.
Very valid.
But the true power of transfer entropy does not lie in analyzing two isolated variables. The breakthrough occurs when we scale the mathematics to map the entire global contagion architecture.
The macro view.
Right. We compute the directional flow of information across every major market index on Earth, and we net out the bilateral flows. When you do this, drawing heavily on the foundational 2002 work of Marchinski and Kantz and the 2014 mapping by Sensoy and colleagues, a deeply persistent topology emerges.
You are referring to the global flow network.
Yes, the global flow network. The global financial system is not some flat, symmetric network where everything influences everything equally.
Of course not.
It is a strict, measurable hierarchy. The United States sits at the absolute apex as the dominant information exporter. It is the fundamental storm creator of global volatility.
The U.S. sneezes, the world catches a cold.
Exactly. And beneath the U.S., you have the major European hubs: London, Frankfurt, Paris. These form Tier 2. They serve as dual-role nodes.
They receive and transmit.
Right. They receive massive information flows from the United States, process them, and transmit that directional information downward. Then, at the third tier, you have the Asia-Pacific markets: Tokyo, Hong Kong, Sydney. Structurally, according to the transfer entropy mapping, these markets act as vast shock absorbers. They are persistent net importers of information, constantly dampening the volatility generated in the West.
I mean, the hierarchy you describe is numerically undeniable in the literature. I agree with that. But the nuances within that map often contradict straightforward economic intuition.
In what way?
Well, this contradiction should give us pause about what exactly we are measuring with this metric. The map largely mirrors global GDP rankings, which, we would expect. The largest economy drives the most information.
Exactly.
But there are glaring anomalies. Small, highly open economies punch vastly above their weight. Switzerland and Singapore emerge as massive information transmitters in the foreign exchange networks, broadcasting directional flow far out of proportion to their domestic economic footprints.
Wait, why do you view that as an anomaly rather than a precise reflection of reality? Switzerland and Switzerland are massive global banking hubs.
Because it suggests we are mapping structural financial piping, capital flows, regulatory frameworks, and institutional clearing dominance, rather than pure macroeconomic causality.
Financial piping is part of the causality.
But transfer entropy is just showing us the physical routing of institutional capital, not necessarily the economic source of the fundamental pricing information.
The vulnerability of this mapping exercise becomes glaringly apparent when we consider how the network behaves under stress, and the mathematical assumptions required to measure that stress.
See, I argue that the behavior under stress is exactly what validates the metric. Transfer entropy provides a numerical signature for structural collapse.
A numerical signature.
Let's look specifically at the Marchinski and Kantz data. In calm, normalized market conditions, the United States drives European equity markets at a ratio of roughly 3-to-1.
Right, 3.1. For every bit of directional information flowing from Frankfurt to New York, 3 bits flow from New York to Frankfurt. That is the baseline asymmetric edge.
But that baseline is highly unstable. It shifts predictably during structural breaks. The topological signature of a crisis completely rewrites this map.
During the 2008 financial crash, that normal 3-to-1 ratio blew out to 5-to-1.
Right.
As the subprime crisis accelerated, the reverse flow from Europe to the US collapsed to absolute zero. The network shifted from a distributed, semi-reciprocal system into a strict unidirectional broadcast.
Because the margin calls were in dollars. Exactly. Think about the physical mechanism. Margin calls were happening in US dollars, forcing European funds to liquidate. Europe ceased to be an independent price discovery mechanism. It became a pure receiver of American panic. Transfer entropy captured that exact structural mutation perfectly.
And what happens when the crisis does not originate in the United States?
The map perfectly reflects the origin point. Contrast the 2008 structural collapse with the 2020 COVID crash.
Okay.
The network mapped an entirely different crisis signature. During the initial Wuhan outbreak, China briefly inverted the global hierarchy. For a narrow, highly volatile window, China became the apex net information exporter, broadcasting shockwaves outward, before the traditional U.S.-dominated structure violently reasserted itself as the virus reached Western markets. We also see these inversions with geopolitical wildcards. During escalations in the U.S.-China trade war, the transfer entropy flow from Shanghai to New York flipped positive, the flow inverted. Measuring these inversions provides real-time quantitative evidence of structural shifts before price magnitudes fully reflect the new reality.
Okay, but measuring across these crisis inversions introduces the absolute deepest mathematical flaw in the application of transfer entropy.
Which is?
The stationarity problem.
Okay, explain exactly what you mean by the stationarity problem for the listener.
Right, so transfer entropy mathematically assumes that the underlying data-generating process remains stationary over the estimation window. You are attempting to calculate a probability distribution based on historical data.
Correct.
To do that accurately, the fundamental rules governing that data cannot change while you are observing it. If you transition from a low volatility bull market into a high volatility crash halfway through your observation period, the data is no longer stationary. The statistical properties have completely mutated.
You are arguing that the calculation window inherently corrupts the measurement.
Exactly. If a researcher calculates a single transfer entropy value using a window that bridges, say, the pre-COVID calm and the COVID crash, they are taking two completely distinct information architectures, mathematically blending them together, and producing a number that represents neither.
Well,
It is a mathematically meaningless output. The fluid nature of financial regimes means that by the time you have gathered enough stationary data to compute a reliable probability distribution, the market has likely already transitioned into a new regime. Your beautifully calculated directional edge is based on a market structure that no longer exists.
that is a legitimate concern regarding the operational mechanics of the metric, I'll admit. But it is not an insurmountable barrier.
It's a pretty massive barrier.
It is a filter. It's a filter that separates robust institutional analysis from purely academic theory. To map these shifting regimes effectively without violating stationarity, we utilize adaptive windowing techniques.
Rolling windows?
Yes, rolling windows. We do not lazily blend the pre-crash and post-crash data. We measure the flow on a tight, rolling basis. We track the derivative, the rate of change of the transfer entropy, to spot the exact moment the information architecture fractures. But the noise,
The complexity of managing those rolling windows and ensuring stationarity is precisely what preserves the alpha. If mapping the nonlinear flow of global capital were as simple as running a linear regression in a spreadsheet, the asymmetry would be arbitraged away by the broader market in an afternoon. The structural difficulty of the measurement is the moat protecting the strategy.
the moat you describe is built on extremely unstable ground. Let us explicitly quantify the danger of this data hunger.
Okay, let's quantify it. I refer to the comprehensive textbook by Bossemeyer and colleagues published in 2016. Unlike a simple correlation coefficient, which can stabilize and provide directional intuition with just a few dozen observations, transfer entropy requires mapping multidimensional state spaces. You are estimating joint and conditional probability distributions.
Which requires a massive amount of historical observation to fill those probability buckets accurately. I agree.
Precisely. To separate true information flow from mere sampling noise, you require thousands of distinct data points. Let us apply this requirement to macroeconomic data.
All right.
If you are analyzing 30 years of monthly inflation prints, employment reports, or GDP revisions, you possess exactly 360 data points.
That's true.
Applying transfer entropy to a data set of 360 points results in severely biased, naive plug-in estimates. The mathematical grid has far too many empty boxes. Because the algorithm is starved of data, it will confidently report directional flow where absolutely none exists, entirely due to finite sample bias. The metric literally hallucinates causality.
Come on. Applying nonlinear probability estimators to 360 monthly data points is just mathematical malpractice. The limitation on low-frequency macro data is fully acknowledged by the quantitative community.
Well, it's still done in the literature.
Which is exactly why the primary application of transfer entropy has migrated away from traditional macroeconomics and into high-frequency and alternative data spaces. We apply it to tick-level order book data, millisecond sentiment parsing, and millions of daily options trades. In these data-rich environments, we generate tens of thousands of observations in a single morning. The finite sample bias effectively drops to zero.
The sample size is only the first hurdle. The parameter sensitivity crisis is far more severe, and it persists even if you possess infinite data.
Parameter sensitivity.
Yes. I point directly to the 2022 work by Causality and Pagnotoni in Statistical Methods and Applications. To compute transfer entropy on continuous financial data, like the exact price of an equity, the analyst must make highly subjective discretization choices.
You have to slice the continuous price curve into discrete, manageable buckets to calculate the probabilities. That's standard.
Yes, but you must select the embedding dimension, which dictates exactly how many historical lags constitute the current state of the variable. Furthermore, you must choose the bin size, determining how you slice that continuous price data into discrete probability states.
Right.
Do you divide daily returns into 3 bins, down, flat, up? Or do you divide them into 5 bins, severe down, flat, up, severe up? Causality and Pagnotoni demonstrated that completely reasonable, mathematically defensible variations in these parameter choices can cause the final transfer entropy estimate to literally flip its sign.
Meaning the direction of the causal flow reverses entirely?
Precisely. When an analyst's choice between a 4-bin discretization scheme and a 5-bin scheme can change the empirical output from asset A strongly drives asset B to asset B strongly drives asset A, the methodology becomes infinitely malleable.
I think you're overstating the malleability.
The line between profound empirical discovery and aggressive data mining completely vanishes. The analyst is no longer discovering the physical laws of the market. They are simply turning dials and adjusting bin sizes until the backtest produces a tradable signal. Couple this subjectivity with the computational bottleneck, and the framework becomes incredibly fragile.
Okay, I want to address the computational bottleneck before we return to parameter sensitivity. Explain the scaling issue for the listener.
Gladly. If you want to run a standard correlation matrix on a quantitative universe of 500 stocks, your software computes it in a fraction of a second. But transfer entropy is asymmetric. You have to measure A to B and B to A.
Right.
Mapping the complete directional network for 500 stocks requires 249,500 pairwise directional estimates. Because of the nonlinear probability estimation, estimating joint distributions for 250,000 pairs takes hours or even days to compute on standard architecture. The scaling is strictly quadratic.
The quadratic scaling issue and the massive computational burden were absolute constraints maybe 5 years ago?
They are still constraints for many.
Today, massive GPU acceleration and parallel processing have rendered that computational bottleneck entirely irrelevant for institutional players. We can compute those 249,500 pairwise estimates in minutes, not days. And the reason quantitative funds dedicate massive, specialized server farms to this specific task is because of what transfer entropy reveals about the taxonomy of information decay.
You are referring to the speed at which markets absorb new information.
Yes, it does not just tell us who drives whom, it measures the exact speed at which market efficiency operates. It provides the information half-life. By measuring the decay of directional flow across different time lags, we can map the exact duration of an exploitable edge. The taxonomy provided by the data is remarkably precise.
Let's hear the taxonomy then.
Consider macroeconomic data. Despite the sample size issues on historical data, intraday reactions to macro releases like payrolls or GDP releases carry exploitable directional flow for roughly 2 days. You can detect persistent transfer entropy flowing from a surprise payroll print into sector-specific exchange-traded funds a full 48 hours after the release.
But as you move down the timeline into corporate specifics, the window collapses.
Drastically. Corporate earnings possess a drastically shorter window. The directional information flowing from a major earnings surprise into correlated equities within the same supply chain decays within exactly 4 hours.
4 hours.
4 hours. If a major semiconductor manufacturer misses earnings, the directional flow into the companies that supply their raw materials persists for 240 minutes before full absorption.
The measurement of these half-lives is fascinating from an academic perspective, I'll admit that. But it creates an inescapable matching problem for the financial practitioner.
The matching problem.
Yes. The operational reality dictated by transfer entropy is that your trading horizon, your actual ability to execute, must be faster than the decay rate of the signal. If you are a discretionary portfolio manager analyzing that semiconductor corporate earnings release, and you rely on human cognition to read the transcript, digest the guidance, and model the cross-asset implications,
You're too slow.
Exactly. The 4-hour half-life means you are structurally disadvantaged. By the time the human analyst decides to trade, the directional flow has completely flatlined. The market has fully absorbed the surprise.
Precisely. Transfer entropy mathematically formalizes the boundaries of human trading. It proves exactly where human cognition is too slow to compete. But the decay curve continues far past the 4-hour mark, deep into the microstructure of the market.
Down to the millisecond.
Yes. High-frequency trading signals and algorithmic reactions operate in a totally different temporal dimension. When the Federal Reserve releases an interest rate decision, the transfer entropy spike registers in the Euro-USD foreign exchange pair within 4 milliseconds.
4 milliseconds.
4 milliseconds. When Apple releases earnings, the nonlinear directional flow hits the broader tech index within 100 milliseconds. General order book and balance signals used by high-frequency firms decay into pure statistical noise within 200 milliseconds. Transfer entropy gives us the definitive, physical map of market latency.
Look, I completely agree on the speed of absorption, but we must rigorously interrogate the fundamental nature of what we are actually measuring at those millisecond horizons. Are we genuinely uncovering new economic alpha? Or are we simply using incredibly complex mathematics to map the mechanical latency of modern market microstructure?
What is the functional difference at that speed?
The difference is profound. When you detect a 4 millisecond directional flow from a Federal Reserve server in Washington to a matching engine in New Jersey, you are not measuring economic causality.
I disagree.
You are measuring the physical transit time of light moving through fiber optic cables between co-location facilities. You are mapping physics, not finance. Identifying that signal does not grant you an actionable edge unless you physically own a faster, straighter cable. Transfer entropy at that micro scale ceases to be an economic indicator and becomes a deeply expensive stopwatch.
Mapping the physical transit of information is exactly what allows intelligent routing algorithms to avoid toxic flow. Understanding latency is an economic edge. But, the utility of transfer entropy extends far beyond the colocation facilities of high finance.
Now we're getting into other domains.
Right, because the methodology is fundamentally agnostic to the domain. If we extrapolate this mathematical tool outside of financial markets, we uncover its capacity to revolutionize entire physical industries. Consider the global supply chain revolution.
Supply chains are arguably a much better environment for this tool.
They are.
Let us apply the transfer entropy framework to a massive manufacturing pipeline. The analogy here is a sprawling plumbing network. Traditional correlation analysis looks at the system and notes that water damage in the basement frequently coincides with rainstorms.
Right.
It is asymmetric, historically true, and operationally useless observation. A supply chain manager tracking supplier delivery delays, inventory buffering, and customer complaints faces the exact same problem. Correlation reveals that delays and complaints happen together.
Which typically leads management to enforce broad, inefficient capital allocation. They try to buffer all inventory simultaneously because they simply cannot isolate the specific trigger.
Exactly. They spend capital blindly. But apply transfer entropy to the operational data, and the precise causal architecture emerges. The math reveals that delays from supplier A cause a spike in customer complaints exactly 3 days later, registering a massive 0.4 bits of directional information flow. It is a severe deterministic causal link. However, delays from supplier B show a directional flow of only 0.02 bits toward customer complaints. It is pure statistical noise.
Meaning supplier B's delays are absorbed by natural slack in the operational system.
Correct. Without this asymmetric map, management burns operational capital buffering both suppliers equally. With transfer entropy, they deploy precision resource buffering based exclusively on causal lag, ignoring supplier B entirely and focusing massive resources on supplier A.
That is an incredibly efficient use of capital.
Furthermore, bidirectional transfer entropy calculation allows us to detect vicious cycles within the corporate structure. If we measure strong directional flow from supplier A delays to customer complaints, and simultaneously detect a strong return flow from customer complaints back to supplier A delays, we have mathematically mapped a reflexive feedback loop.
The complaints cause pressure.
Yes, the complaints are causing management pressure, which causes operational panic on the factory floor, which generates further delays. Transfer entropy shifts the management paradigm from noticing that things happen together to surgically identifying causal lag, directional force, and structural feedback.
The supply chain application is highly compelling, specifically because the underlying physical processes are genuinely stationary compared to financial markets. A manufacturing plant operating on strict logistical schedules does not suffer from sudden, psychology-driven regime shifts the way a global equities exchange does.
The rules don't change overnight.
Exactly. The rules of the factory floor do not change overnight because of a panic. But if we are looking for the truest calling of transfer entropy outside of finance, we must look toward the absolute frontier of computational science, artificial intelligence interpretability.
You are referring to the black box problem of neural networks.
Yes. We are currently deploying massive transformer models architectures so intensely complex, with billions of parameters, that they function as completely opaque black boxes even to their creators. We observe the data input and we receive the generated output, but the internal routing of data through the hidden layers remains deeply mysterious.
Right.
Researchers at DeepMind and Google Brain are actively deploying transfer entropy to map the internal causal architecture of these large language models. They calculate the directional information flow between individual attention heads and specific hidden layers.
They are essentially mapping the cognition of the machine. They are finding out which part of the network is actually doing the thinking.
Exactly. Transfer entropy identifies which specific attention heads actually drive the final output generation, and which heads merely recirculate existing context without adding value. It acts as a highly precise functional MRI for artificial intelligence.
It's incredible.
And crucially, because the neural network's architecture is static and the data flow is strictly controlled by the researchers, the stationarity and parameter sensitivity problems that completely plague financial applications are drastically mitigated. We can finally observe the pure, directed reduction of uncertainty in an isolated, controlled environment.
The AI application is a perfect demonstration of the tool's absolute validity. The math flawlessly identifies the hidden drivers within a complex system. And that brings us back to why it is so overwhelmingly valuable in capital markets, despite the noise and the stationarity issues. Markets are the ultimate complex system. The asymmetry we extract from that noise is the very definition of a financial edge.
But applying this back to capital markets introduces the ultimate philosophical constraint, a phenomenon entirely absent in both supply chain logistics and isolated AI models, the reflexivity trap.
Okay, walk us through the mechanics of reflexivity in this context.
Capital markets are inherently aggressively reflexive. The act of measuring the system alters the physical reality of the system. Let us return to your Global Contagion Map.
Sure.
If transfer entropy definitively maps a persistent, highly exploitable directional flow from U.S. equities to European equities, and quantitative funds deploy billions of dollars in algorithmic capital to systematically front-run that U.S. to Europe transmission, the act of trading the signal fundamentally alters the flow. Widespread adoption of the metric arbitrages the causality away. As capital floods into the transmission channel trying to exploit the lag, the 4-hour half-life compresses to 4 minutes, then 4 milliseconds, until Europe perfectly co-moves with the US instantly.
The lag disappears.
Yes. And when the lag disappears, the simultaneous movement becomes symmetric again. Transfer entropy drops to 0. Does the map itself destroy the territory? By proving exactly who drives whom and providing the mathematical framework to exploit it, the methodology contains the seeds of its own obsolescence.
The reflexivity trap is a feature of market efficiency, not a flaw of the metric itself. The fact that the signal eventually compresses and the lag disappears proves that the transfer entropy correctly identified the true causal channel in the first place.
I suppose.
The market recognized the truth of the measurement and priced it in. The edge, therefore, lies in the constant, computationally intensive discovery of new, emerging asymmetric flows before they are widely mapped by the rest of the street. It is a perpetual arms race of causal discovery.
It is definitely an arms race.
When we synthesize everything we have discussed today, from the failure of linear Granger models to the global mapping of crises, down to the millisecond latency of high-frequency trading, a profound conceptual leap becomes apparent. We have moved from merely observing simultaneous events to charting the precise mechanics of market physics. The asymmetry is the edge.
Frankfurt, while only a trivial 0.15 bits flows back, is the entire ballgame. The direction of the flow is infinitely more valuable than the magnitude of the connection.
The conceptual beauty of an asymmetric world is not in dispute, but the actual extraction of that asymmetric from live, chaotic market data remains deeply perilous. The practitioner must approach transfer entropy with profound caution. The immense hunger for data cannot be ignored, lest we hallucinate relationships that just do not exist.
Caution is always warranted. The extreme sensitivity to discretization and lag parameters must be rigorously controlled to prevent the creation of highly optimized, entirely fictional causal arrows. We must maintain a strict, unyielding firewall between measuring the mathematical reduction of uncertainty and claiming actual economic causality. The tool maps the sequence of predictability. It does not map the underlying truth. The asymmetry is undeniably powerful, but the illusion of certainty it provides can be devastating if the parameters are tuned to fit a narrative rather than reflect reality.
Despite the rigorous demands of parameter tuning and the undeniable data requirements, the framework provides an unparalleled lens into complex systems. Transfer entropy perfectly completes the Information-Theoretic Trilogy.
The trilogy.
Yes. We began our understanding with Shannon entropy, which defines the pure state of uncertainty within a single isolated system. We advanced to mutual information, which reveals the symmetric structure and shared dependencies between multiple systems. Transfer entropy adds the final critical dimension, the dynamics of the system.
Right.
It grants us the arrow of time. It provides a comprehensive diagnostic capable of telling us the state, the structure, and the exact directional momentum of global capital.
Yeah, it is, without question, a massive conceptual leap from simply asking what moves together to mathematically defining the engine that drives the movement.
This is the research desk officially signing off.